Hey buyers, with mortgage interest rates going through the roof, are you wondering if there's a way to reduce your monthly mortgage payment? Well, there is, and it's called a mortgage buy down. We're going to discuss some of the differences between a permanent buy down and a temporary buy down, like a 3-2-1 buy down or 2-1 buy down. And this is a guide for buyers and sellers because we're going to discuss the reasons that buy downs may make sense for both buyers and sellers in this market. Hey there, Christian Walsh, real estate agent with Wire Associates. We have been helping buyers and sellers make the best data-driven decisions in this crazy market. We were inspired to create this video by one of our subscribers, Les Momo. Les said, "Hey, Christian, could you do a video on seller buy downs?" Well, yeah, here I am, Les. I promised I would, and I want to get this to you. But let's clarify, they're technically mortgage buy downs. It can be paid for by the buyer or the seller. So in this market, it may make sense for sellers to pay for it, but we're going to explain exactly what the buy down is, and then from there, it can be decided who's going to pay for it. So if you're ready to dive into some actual numbers to see how buy downs work, hit that like button and let's get started. So let's actually put some numbers to these mortgage buy downs so you can see if it's going to make sense for you. And that is whether you're a buyer or seller. We are using a sample case. This is a single family home, $1 million purchase price. The buyer's putting 20% down. It's going to be a 30-year fixed rate mortgage. And the interest we're going to start with is 7%, which these days is about the going rate. Unbelievably, how quickly rates have gone up. So what we're going to do is we're going to run through the monthly payment. We're going to only use principal and interest for the monthly payment. It's not going to include insurance, property taxes, HOA dues, only the principal and interest. It'll be easier. We're going to talk about the cost of that buy down or that scenario that we're going to run through. And then we're going to mention the down payment because there's a slight change later on that comes to the down payment. But for the most part, the down payment will stay the same. Another important point, there will be no mortgage insurance due because of the 20% down that is being used. So first off, we need a baseline, and that would be no buy down. So if there isn't a buy down, if we're just going with a 7% interest, the monthly payment for principal and interest will be $5,322, and the down payment, as we mentioned, will be 20%. That is $200,000. Now let's first move into the permanent buy down. And by permanent buy down or lifetime buy down, we mean for the life of the loan. As long as the buyer has the loan in place, they're going to have that reduced interest rate. Well, how does this happen? This happens by paying what are known as discount points. And what we're doing in this case, in this scenario for the permanent buy down, is we're buying down the rate about 0.5%. So we're going to take it to 6.5% from 7%. Now, in order to do this, there is going to be a fee that's paid, prepaid interest, the discount points that are paid, and they'll be paid ahead of time when the property closes. They will be approximately 2.5 discount points. And a point is equal to 1% of the loan amount. So 1 point may get you about 0.25% buy down. To get to 0.5%, it's not going to be 2 points. It's going to be 2.5. There will be variation. It's going to depend on where rates are, cost for the loan. It's going to depend on the lender. Your mortgage broker is going to be able to help you figure out exactly what the discount points are. Here we're using 2.5. It's a good back of napkin. That means it will cost $20,000 for the 0.5% discount. It'll cost $20,000 to take the mortgage interest from the going rate of 7% down to 6.5. When you do this, your monthly payment will drop to $5,057. It's a savings about $265 a month for the life of the loan, as long as the loan is there. If it's a loan that's held for the full 30 years, every payment will be $265 lower in this scenario. If it's held for 2 or 3 years and refied, then it would be lost going into the future. There's a new loan. Now, again, down payment stays the same in this scenario. No change there. Now moving on to the temporary buy down. We've been hearing a lot about these, a 3-2-1 buy down, a 2-1 buy down. We're going to explain why they're considered temporary, and we're going to explain why they may be mutually beneficial for a buyer, of course, lower monthly payments, and for a seller, it's better than doing one other thing that I'm going to show you. What does this temporary buy down mean? Well, it means it's not permanent. It's not for the life of the loan. It is for a shorter duration in the loan, and it will vary depending on those numbers. 3-2-1, 2-1, or 1-0. And that means that a 3-2-1 buy down, for example, the 3 refers to buying the rate down 3 percentage points. The 2 is 2 percentage points, and the 1 is 1 percentage point. And that is for the first 3 years. So when you hear a temporary buy down, you hear a buy down of 3-2-1. And there's a lot of builders out there right now that I hear are offering the 3-2-1 buy down. That means the first year is a 3% discount on the interest rate. Second year is a 2% discount on the interest rate. Third year is a 1% discount on the interest rate. Fourth year, the interest rate goes to what the full interest rate would be. So in our example, not to get confused here, and I know everybody sees all these numbers and maybe your palms are sweating, but in this example, a 7% interest rate, the first year would be 4% because that's 3% off of 7. The payment will be $38.19. Year 2, with the 2% buy down, the rate will be 5%. Payment will be $42.95. Year 3, you're catching on quickly. Year 3, it'll be a 1% buy down, and that'll make it a 6% rate. Payments will be $47.96. Year 4, buy down's gone. It was temporary. You're back to full payments, and that's the $53.22, like we talked about in the beginning. That is a 3-2-1 buy down. Let's go down before we move over to the other columns. The 2-1, just as you guessed, would be 2% reduction in interest rate the first year, so it'd be 5. Second year would be a 1% reduction, so it'd be 6. And the third year goes to normal, 7. And the temporary, the 1-0 buy down, it's 1 year. That means that for 1 year, the interest rate would be 6%. Then it goes to 7. So the 2-1 buy down, you get $42.95 the first year, $47.96 the second year. Third year goes to $53.22. And the 1-0, the 1 year buy down, it would be $47.96, then $53.22. An important point on a temporary buy down is that the buyer must qualify at the unbought down rate. So in other words, in this case, the buyer must qualify for the purchase at the 7% interest rate. Even with the buy down and early on, it's not like you can qualify if you can only afford $38.19 at the 4% rate. No, you have to be able to afford the $53.22 payment. We'll be right back, and we're going to tell you how to calculate the cost of the buy down. And don't forget that we're real estate agents based in Southern California. If you're a buyer looking for somebody to negotiate a buy down for you, or a seller who wants to sell and use this to your advantage to properly position your home for sale, reach out to us. We can help you in Southern California, and if you're outside our area, we'll find the right agent who can help you. Make sure you click the Contact Us below. Let's dive into the cost of the temporary buy down. And here's the quick way to look at it. Essentially, all the discount that the buyer was getting gets added up and put together, and that number, whatever the discount was in the mortgage interest, is essentially what the charge is for the buy down. So in other words, for a 3-2-1 buy down, you'd take $53.22 and subtract $38.19. That number is added in, and then you subtract $42.95 from $53.22, $47.96 from $53.22. The difference in the payments adds up to $36,672. That's the cost. There's no free lunch here. It still is paid. It's just essentially escrowed and sitting on the side, and it kind of gets lumped together with the payment. So that's what you need to understand. In order to do a temporary buy down, there's no free lunch. You have to pay the money, and it gets paid at the close of escrow. That's what these numbers are. So the $36,672 will be the approximate cost of a temporary 3-2-1 buy down. And what it is equivalent to is essentially the discount that you're getting in years 3, 2, and 1. Again, no free lunch. Again, down payment stays the same. We're getting to a point where it's different, don't worry. The 2-1 buy down, which is becoming more common out there, is a discount in this case of $18,636. That must be paid at the close of escrow in order to get this payment schedule for the buy down. And then the 1-0 buy down is $6,312. So I hope that makes sense. Let me know in the comments below if you don't quite understand that. Okay, moving on. And we're going to talk about who can pay this and why that's important and how this works. What are two other ways that a buyer could potentially reduce their monthly payment? Well, the other way to reduce your monthly payment as a buyer is to increase your down payment. And that's what happens if a buyer brings an additional $50,000 to the table on $1 million home. Their down payment increases to $250,000 and their loan payment goes to $4,990. But a buyer may not have that money. They may not want to put that money into the deal. The other thing that could happen is the seller could reduce the price. Now, sellers, I hope you're still tuning in and I hope you're paying attention, because here's where it gets very important for you. If a seller reduces the purchase price by $50,000, that's $50,000 fewer dollars going into your pocket, it is going to reduce the payment to $5,056, which is similar to what happened when we did the permanent buy down. It's very close to that number. But it's costing the seller $50,000 in this case. And the other bonus for the buyers, they only have to bring in $190,000, so they get to keep $10,000 more in the bank, use that for upgrades or just keep it in the bank. So that is one route to go. But sellers, I have a better way where you're going to actually net more money. You could go ahead and drop the price $50,000 and lose out on that money. Or let's go back up to our temporary buy down. Heck, let's go up to our permanent buy down. So as a seller, if you want to get the buyer's payment down for them, at the same time preserving as much equity as possible for yourself, why don't you do a buy down? Offer to buy down the buyer's loan, and it's going to save the buyer money and you're going to net out higher. Here is where it gets interesting. So $5,057 versus $5,056. So a $50,000 price reduction in this scenario is the same as a seller paying $20,000 to do a permanent buy down for a buyer. The payment nets out the same. The difference is the seller has $30,000 extra dollars in their pocket. And the buyer has to kick in an extra $10,000 for the down payment, but they were already committed to that. So the seller nets more money. The buyer has a mortgage payment that's more affordable, and everybody can go ahead and march off to closing and be happy. The other thing the seller can do is they can do the temporary buy down. And what this does is it makes life a little easier in the first 1, 2, or 3 years for the buyer of the home. So the seller could, in the most expensive case, do a 3-2-1 buy down and have to kick in $36,000. But these other buy downs are going to be beneficial to the buyer, and they're going to cost the seller less than reducing the price of the home. One other advantage for the buyer is if they decide to refi ahead of the schedule, because let's just say rates hypothetically in the next 2 to 3 years drop, and they could be dropping in a year or less. If rates drop and you've done a temporary buy down, the money that's still in there, because remember, it's not like points that were paid ahead of time and disappear. The money will be essentially escrowed and held. The money that is still left over because you didn't use it all up for the temporary buy down, that can be applied towards principal. So that's another benefit for the buyer. Let us know your questions below. I know we ran through a lot of numbers and a lot of scenarios. Let us know, buyers, if this is something that you're going to attempt to negotiate. And sellers, would you use this when selling your home in lieu of a price reduction? Let us know in the comments below. Make sure you reach out if you need help from a real estate agent, and make sure you subscribe to our email newsletter. And if you want to take a closer look at this infographic, make sure you subscribe to our free weekly email newsletter, and you'll get a copy of this that you can download. And check out this next video on the housing market you're not going to want to miss. Thanks for tuning in. This has been Christian Walsh, real estate agent with Wire Associates, and we want to hear from you.